This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group. We're here with a special edition of our Energy Markets podcast. You can learn more about us at commodityresearchgroup.com, where we post our podcast and blog. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for any trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. So today is April 1st, and we have a very special guest. It's his second time on the podcast, Andy Furman. Andy, for the last 12 years, has been a risk management consultant at Risk Revenue, or called R Squared. Risk Revenue, founded in 2001, is an independent commodity risk advisor that works with clients to build and maintain hedge programs, how appropriate for these markets. R Squared patented analytics assists clients ranging from S&P E&Ps to private equity to energy consumers. Located in Houston, you can find more on Risk Revenue at riskrevenue.com. That's RISKED revenue.com. And I'm going to switch it over to Andy Lebow to take it from here.
Okay, thank you very much, Jim. And it's such a pleasure to have Andy Furman on our podcast today. I've known Andy both personally and professionally for a long time. And he is really one of the best in the industry at giving hedge advice to all types of the industry. But one of his main clients, of course, are crude producers. And what better time to talk about hedging, really, and hedge advice than where we are right now. Also, Andy has a book coming out, I think, this summer, which we will no doubt be talking about during the podcast. So, Andy, welcome. And our first question is, all right, the crude market has basically collapsed. The front month is trading at $20 right now. What are you telling your crude producer customers right now?
Oh, first off, Jim and Andy, thanks for having us on the podcast. I'm actually a regular listener, so I'm a real big fan of you guys. You guys do a great job of talking fundamentals and giving your listeners a lot of good information about what's going on in oil. In terms of your question, what are we telling our clients right now? Every client is different, and each client has their own risk profile. They have their own asset profile. They have got assets, for example. Where are their assets located? Are their assets in the Gulf? Are their assets, let's say, in the Scoop Stack? It really depends. And they also have asset. It's also another issue for them is credit capacity. So you have to look at each client individually and frame your answer for how you help them regarding what their profile is. But specifically speaking, in terms of, let's say, an individual, let's say, calls up right now, you walk through, what is their objective in terms of what are they trying to accomplish right now in terms of mitigating their risk, and then you want to try to dial into what kind of minimums they're trying to defend in terms of trying to figure out what their minimum for success is. And then from there, you try to build a plan. Once you've done that, you also try to go into the tactical area in terms of like the first things I just mentioned before were more strategic. You've got tactical questions in terms of how you're going to go about doing the hedge. In terms of whether you're going to be doing it all now or whether you're going to be layering it in pieces. What we try to advise our clients to do is make it a series of hedge decisions. That's one of the most important things that you can do, I think, right now, is that clients right now in this kind of emotional environment, where there's just so much tumult and so much change, in the last couple of weeks. It's impossible for there not to be a little bit of emotion involved. And so you can remove the emotion by making it a series of hedge decisions that you can, for example, let's say you want to hedge 3 units of crude. Well, you hedge 1 unit now, and then you turn it into a decision tree for how you're going to go about hedging the next 2. It's very, very important to have a decision tree because many clients, for example, on the sell side as a producer, they're going to be more comfortable in terms of, if the price rises, what are we going to do? Well, you also want to have a plan for what to do if prices go down. Even if there's no plan to do anything on the downside, that's a plan. At least you can articulate that, and then you can make better decisions that way. And you'll be in control of what you're going to do.
Andy, to me, it's kind of been in a situation before where the market's collapsing and you get a phone call from somebody who's got like a producer, and they say, well, what do I do now? And it's kind of, you're looking at the house is on fire and the guy wants to buy fire insurance today. And so, I mean, are you telling people, are you still putting hedges on at these levels for some clients? Or are you saying, this is, you're better off waiting, or how does that, it still depends on who you're talking to?
Absolutely. It depends on who you're talking to, and the answer is really all of the above. We've got some clients that we're hedging for. We've got other clients who are considering removing hedges because they're contemplating either scaling back their CapEx or potentially shutting in or potentially both. So everything runs the gamut. Everything is on the table in terms of being discussed. And that's really where we have to go. That's why each client has a different answer.
Well, I was just going to say, we're looking at some of the pipeline companies telling their producers to not to cut back on production. And so I guess is it a situation that you're seeing where you're making money on the hedge, but the sort of the basis to the cash, to the area where you're selling your crude is just falling apart? Is that happening already?
Well, that could certainly be part of it. I think it's worth talking to our listeners and mentioning that, like earlier today, I was looking at the screen and we had Mid-Cush $4.50 into the screen. That's the Midland basis. We had, that's in spot, LLS minus 475, MEH minus 275. Those values were positive before, Russia and Saudi Arabia made their moves, and also with, coronavirus and the, stay in place, shelter in place.
One question that, talking about, a decision tree and where to hedge, Andy, the market is a big carrier, a contango, as we call it in our market. And, you look out on the curve and, Cal 20, the balance of Cal 20 is like 29 and 21 is 35 and 22, 38 something, on a swap basis. Are you advising clients to put their hedges, in the backs and the fronts, in the middle of the curve? And also, what are you actually seeing them doing?
Well, I hope that your listeners don't think of this as a dodge, but they're doing all of the above.
Right.
Okay.
Right.
It's really, it's a whole mix because let's just say, for argument's sake, I have a client who is under-hedged in 2020. They're going to get a different answer than a client who was well-hedged in 2020, right?
Right.
So let's just talk in some hypotheticals. Let's just say, for argument's sake, I do have that client who's well hedged in 2020. I would be telling them, hey, let's look at 2021 and see how you're doing there. And maybe we can add some hedges here because, the fact that you've got the term structure is such, with really generous contango, $6 is not a bad deal to be able to hedge, let's say, at $35 when you've got spot at like, $20, $21. You're getting literally $14, $15 of lift
Right.
off of where spot is, and we don't know how long this price war is going to last. We don't know how long coronavirus lasts. In other words, everyone can say in very, very simple terms that coronavirus is going to kind of fade out in the next couple of weeks, and that and everything's going to improve. But we're dealing with a lot of known unknowns. We don't know what's going to look like, let's say, this summer and this fall, in terms of how the virus comes back, or even if it does really come back. And maybe it's like all these types of variables. We could be lower for longer, and if we are lower for longer, then certainly hedging at $35 now, I think will work.
I think that's a good point, Andy. This is a double shock. It's not just a demand shock; it's a supply shock. So you could have the stock market recover based on the virus, getting behind us a little bit, but you still have the Saudi aggressive policy to deal with. So I think you're right. Just because one thing goes away doesn't mean we're moving into a more certain price environment.
Yeah, I don't think that anyone can really predict, with so many moving variables, that we are going to recover in price, and I certainly hope that we do for the sake of our producers. I'd love for us to go back to $50, for them and for their economics. But that's why we have to dial into the risk. One of the things that we do, when I mentioned, in terms of having a discussion with our clients, we look at the low case risk, and then we determine, what are they going to look like at that price, and is there a way that we can hedge in order to bring that low case risk up?
Andy, were you on the floor during the Gulf War crisis?
I was.
So you were in the options ring at the time, right?
That is correct.
I was just going to ask you how difficult it is to get things off when you have somebody who says, okay, let's do a hedge. How is it with bid offer spreads and finding a market maker that'll take the other side?
Well, current conditions are certainly a lot tougher than they were, just a month ago. Pre Saudi Arabia / Russia and the price war, you could get, let's say, diffs, from mid-market to bid on swaps. You could do, let's say, 15, 20 cents. And now you're seeing diffs, of 30 cents or more. Mm. So it's more challenging. And then also because counterparties are literally having to work from their homes, it takes longer because you've got a trader in one home connecting with a marketer in another home. And so logistically, there's all kinds of challenges. It takes longer to do the hedge. There may not be as much liquidity, and because the market's moving around so quickly, they have to basically, have a wider, mid to bid.
Boy, I almost was thinking bring back the floor, but then this virus issue. Didn't everybody get sick? Like, wasn't there like something called a floor virus? Like the first 2 weeks you worked there, everybody got sick, and then.
Oh, it was called floor disease.
Floor disease, yeah.
Yes, it was called floor disease, and I had it. I got it.
So we won't be bringing the floor back soon.
Jim Colburn, I think you caught that floor disease.
I did.
I set you down during crises.
I was worthless, I think. I think I was just adding support. Andy, I have to bring this up because it's just mind-boggling to me, but we've seen $1.50 puts trade in May and June. I put this stuff up on our blog, and somebody commented that they were part of a $5 150 put spread. I'm interested in the three-way strategy for producers where you sell a call and you go to buy the put and it's too expensive and you sell the put underneath. And I'm wondering, are you seeing those kinds of things go in this environment?
Three ways. Yes. Okay.
Are you seeing all strategies, I guess?
Well, we are seeing all of them. Generally speaking, our shop does not push three ways, but at the same time, it can make sense with limited conditions, with limited amounts of the hedge book. And as a matter of fact, one of our clients actually used them successfully, and the reason why was they did more hedge volumes because they were able to do three ways. In
Hmm.
other words, in that kind of a situation where you have a choice between hedging like X, or hedging maybe 1.5 times X, and that extra, 1/3 of your book is three ways, that's a situation which works and makes a lot of sense. Okay. Where it doesn't make sense is if your entire book is with three ways, because then you lose your hedge program when the market drops.
Right. You never expect it to go down below the one that you're short, and when it does, you're
Right.
out of luck. Yeah.
So we're very, very mindful of that. We like to make sure that our clients at worst have balance, and at best, try to use other structures if they can. Sometimes they want the extra premium from the sold side, and that's okay.
Right.
Just within limits.
Yeah.
Well,
I find that or found that when our hedgers started doubling up on the short call side, and even sometimes tripling up, it was a sign that the market had bottomed and is about to turn around. I just thought that was not a good way to go. But if you're only hedging, these are people that were putting on large hedges, and if you're only putting on a tranche, I guess that makes sense, where you could sell two calls to help finance the purchase of the put.
That sounds like almost like a little bit of an extendable.
Yeah, it was. It's just it's kind of a sign where you see, okay, market's getting a little crazy. But Andy Lebow, what do you think of this? We had a EIA numbers today that showed significant build in stock levels. You want to just make a couple comments on what we're afraid that's going to happen with storage filling up is in
well,
fact happening?
we're not only afraid of it, but it is going to happen. I mean, the store, we were up 13 million this week. We're going to be continually up 5, 10, 15 million a week until storage fills. I mean, it's inevitable. The record, I think, for crude stocks is 537 million. I think it's either 533 or 537. We should get beyond that pretty easily. The available storage in the U.S. is said to be 600 million for crude, and I think that what's going to happen is we're going to test what the actual available storage is in the U.S. and globally, which is why we're seeing these humongous contangos. And as Andy mentioned, it's allowed some of the producers to take advantage of that. But I think the contangos may widen. Today there was profit taking in the front, so the front was up and the backs were getting whacked. Today's April 1st. So I think it's inevitable. It's hard. There's really no way out, because demand is not going to recover until some of these travel restrictions are lifted. So we're at least 4 weeks away from that. But I have a question. I have a guy whose book is about to come out. The guy who wrote the book on options, Jim Colburn. And my question is, you have volatility here of what is it, 120%?
It's higher than that.
Yeah,
I mean,
or higher than that. I'm just talking about maybe that's the second nearby or the third nearby.
well, I said, sorry, go ahead, Andy.
Well, what do you do? What do you do with what do you do with that? I mean, how do you approach the market with a volatility that high? And is it worth is it worth buying puts? Andy, you mentioned three ways. Andy Furman, you mentioned three ways. Do you sell options here? I mean, it's very tough to deal with. So I'm interested. I'm anxious to hear what you two have to say.
Well, I can go first, and I can say that there was one strategy that was put forth by someone. I don't remember who it was. They were thinking about, well, what would you do if you had to buy, some kind of an at the money, floor, at the money put, and the price at the time was, I forget exactly what the tenor was, but the price was like $7.50. It was like there is no way. I think it must have been probably like some kind of a 21 structure. I don't remember exactly, but point is that when you start having to pay that kind of premium, well, there's just no way that you can, that's going to make a lot of sense, right? I mean, let's just say for argument's sake, your strike price is, let's say 35. The fact that the meter starts at 27.50, that's not a very, very good way to protect yourself.
No.
So what we try to do is we would stay clear in a higher volatility situation like that, and we would advise, let's say, for example, using a costless collar. And I think costless collars can make a lot of sense here, especially in 21, where for example, let's say you got $35 and you can do something like 30 by 40, and that way you're funding the premium of the $30 floor with a $40 cap, and you don't have to lay out that kind of premium. I mean, that's just one way to kind of sidestep the issue of high volatility and make that work for you. What I will say, though, in terms of paying for options, is that this is one of the rare times where actually buying options can make sense. And I'll tell you why. Okay? If you believe, and I'm not saying that we're there yet, okay, but if you do believe that the sun is going to come out tomorrow and that prices are going to go back up, then you want to have a lot more upside participation. So if you're forced to hedge, if for example, you've got some kind of issues with your debt, or like a debt covenant or what have you, where you need to make a hedge, and you don't like the price, well, buying a couple of puts, buying some put protection on the downside will get you for just a fixed premium there. It'll satisfy covenants, and at the same time, it'll give you the upside, participation that you want and need. Should prices, go back up, for example, if the Russians can make some kind of, headway on pulling back from their stance with the Saudis, and the Saudis can make up as well, and or something with coronavirus, a vaccine, or what have you. So those are the kinds of that would be one kind of isolated example of where you would want to use a fixed premium put to protect yourself. It's not necessarily the first choice, but in a situation where you think that the market can turn, that would present itself as a possibility.
I think that was one of the comments about looking at the premium. I mean, that's the kind of stuff when you're trying to protect yourself, forget about volatility for a second, but eyeball the premium and look at the puts strike that you're trading, and does that make sense? Because when we talk about volatility, that's a standard deviation measure that we're using when we go through we back it out of a model that's based on a normal distribution, and we know these aren't normal markets. So when you're really hedging and you need a price on your barrel, like you're in the real world, you have to kind of eyeball the premium. Just like you said, Andy, I agree with that. I've always had a problem calling something a costless collar, because that $40 call that you sell is giving the upside, but that's what people call it. So I'll let that go. But I think those are great comments that you just made.
Let me just add a little bit to this, because I don't know if your listeners are actually going to be familiar with this kind of concept. Is that most of the time, someone wants to buy a put because they want to get the leverage, right? In other words, if you're a speculator, you're buying a $10 put or a $20 put because you want to see the market crash through that strike price and get like literally multiples of return. For someone who holds an asset like oil, for a producer that holds an asset, it's completely the opposite. No, they're not using leverage. So the reason for buying a put is because you have to you have to get the hedge, and because you want the upside. So that, for example, let's say you have a market which is trading at $25. You want to buy the $20 floor and hope the market just goes the complete opposite direction.
Right.
In other words, the fact that you've got $5 between where the market is and where your price, where the option is struck, that $5, that's a long ways away for you to start getting protection. So you're basically trying to get that protection there just as a disaster, essentially, in case case the market, were to have, pricing on that marginal barrel, and you were to see prices go down to, let's say, $10, or dare I say, even lower. So I think that, if you understand from the concept of the fact that you have an asset and that you're not leveraged, that's the reason why you would do that kind of a strategy.
You turn a long an asset that's priced that makes money when you go up. It's almost like turning a futures into a synthetic call by buying the put.
A deep in the money call.
Yeah, deep in the money call, exactly.
All right, let's talk a little bit about price direction. Do either one of you think it's possible for an asset to go to zero, or for a commodity to go to zero? Is it possible that we could see the WTI futures go to zero?
I think so. Yeah. I mean, the thing that the scenario I see, we saw a whole bunch of investment go into that U.S. oil contract, and these folks are speculators, and they have to roll. I don't know, what is it, between the 5th and 10th business day of the month? I think they still have those rules. And imagine if the storage fills up and they go to sell, I don't know, thousands of contracts, maybe tens of thousands, hundreds of thousands. And the buyer, which might be someone who takes advantage of all those sales and is going to take delivery, is not there. So yeah, I could see it getting very panicky and the market going down to zero.
Well, I'll throw in one other thing, which is that we have seen commodities trade negative.
Yes.
As one example, just recently we saw Waha gas go negative, which is the basis, out in West Texas. So it really depends upon whether the asset is stranded or not. And we've got the most unique situation that I've ever seen in my career. I'm sure that you guys could probably, chime in and say, and corroborate that or not. To have a price war at the same time as a demand collapse is unprecedented. I've never seen it. I've seen a price war. I've seen a demand collapse. To have a price war at the same time as a demand collapse is just the kind of stuff that's the kind of recipe that could actually get you to zero.
I agree. I mean, we finally have taken out the volatility highs of the Gulf War. That was always kind of the Gulf War I. Back in the early 90s, we saw volatility trade up to like 135, and now front month's at 188, the second month's at 153. That was March 20th. That's the high now. So I think the market is basically agreeing with you and say, hey, we've never seen this before. And like I said, the $5 150 put spreads have traded in May, in June. So this is people expecting the possibility that something this continues.
We're also seeing some physical crudes in the single digits. I mean, you look at the Canadian crude, WCS is trading single digits. Permian is not single digits, but low teens. And I think there has been a crude that traded close, at least $5 or $6. So a U.S. crude. So I'm not sure that the futures will go to zero, but certainly some of these physical crudes may end up going negative. So, we look at the front and vis-a-vis this discussion, and you say, oh, it's $20. That's a horrendous price. I guess everything's relative, right?
Yeah, I mean, this zero price is a scenario that, Andy, I've been doing podcasts with you a long time, and one of the things that I take away is that we both agree on this, is anything is possible. And in this market, this is like Andy Furman just said, we've never seen anything like this before. So yeah, everything's possible here. So.
Well, I think what I'd just like to point out is that under normal circumstances, if you see a demand collapse, what is your response as a producer? The answer is, of course, to pull back, right? In other
Right.
words, that lower prices would make the supplier, sell less, and so to have the Saudis, for example, trying to ram these barrels down the market's throat in this kind of environment, it's just, frankly, it's insane.
Yeah, and the economy is not benefiting from the lower energy prices because there's no economy right now. Like I haven't driven my car in a couple of days, so
Right.
I'm
We're not getting the demand response that these lower prices
yeah,
would usually bring.
yeah.
And that, it's going to take a long time, I think, for prices to recover. The many months, probably many months.
All
All
right,
right.
so
Go
Andy,
ahead, Andy.
I want to put you on the spot here, Andy. Can you tell us, when do you think that that WTI up in Cushing, when would that fill?
That will probably fill, I would say, by mid to late May. That will be at tank tops. Latest early June, and which is what we're seeing again in the front with these super contangos, and the cash market at one point traded minus 650. So it's clearly on the way to filling up. Crude runs, of course, are going to be cut in pad 2, and with Cushing, showing a premium to almost every physical crude, as you described, Andy. Every barrel that can get into Cushing, and with the premiums, if you have storage, every barrel that can get into Cushing will get into Cushing. And as a result, it looks, what we have is second or fourth week in May. I think it'll be full.
That's really interesting because we have May, June minus 650 puts. There's like 5,000 open interest on those. And June, July, another 5,000 open interest minus 650 puts. That I made a point in our blog of when the minus $4 puts traded, and now we're seeing these minus 650. But you're saying that's where April, May went out?
No, that's where the
physical
cash roll.
Yeah.
Cash roll is traded. You traded 650 under.
Right. So if that's already happened, May, June is not minus 650 puts. Not that crazy.
Not that crazy.
No.
All right. I want to talk about your book coming out, Andy. Can you tell us about what the title of the book is and what
how's it end?
What's the book about? Yeah. What the plot is. We're always anxious to see how things end, right?
Yeah.
Well, the title of the book is called "Risk is an Asset," and what it's about is just basically, if you're a consumer or a producer or in your midstream, you have to accept risk. Risk is a part of your business, and if you've got a positive, outcome, a positive expected value from running your business, that's good, and you want more of that, which means that you have to accept a certain amount of risk in terms of getting that positive outcome. And so what our book does is it goes through a lot. We discuss a lot about risk-driven hedging, which is, by using a process. Process risk management means that, we're going to have essentially a risk management discipline where we define a minimum low case risk for, whether you're an upstream or a midstream or downstream, client, and that you're going to take a look at that risk case and defend that risk case. So, it's a really, really good opportunity, and especially considering what's going on in today's market, to show how you can always defend a risk case. You can't defend the current prices unless you've had a 100% hedge program from one day to the next. In other words, that you just were able to lock up every single barrel from, let's say, Tuesday to Wednesday. In practice, that never happens. In practice, we've rarely ever seen someone come in and just go from, let's say, having a 0% hedge program to having a 100% hedge program. It typically is. It's not going to go that way. So if that's the case, and you've got a base case, what you want to do is you want to have a structure, a process for being able to manage that low case. And that low case for one client could be different than for another. It's really what their minimum measure is for success. And so if I was, for example, a consumer of crude oil at, let's say, $50, and I wanted to make sure that that my cost didn't go over $70, then what we would do is we put that in budgetary terms. Let's say, for example, that $70 was my bogey, and we would manage to that case so that we were able to use the process to make sure that you're getting all the hedges that you need and nothing more. Because we want to, let's say, have that risk, but we don't want to have too much risk. And so we're able to use that process to be able to define what that risk case is and make sure that that's being properly managed. For the example of a producer, in this case, if a producer is using this process risk management, they would be able to look at their budget and they'd be able to see, oh, okay, you know what? We have a certain amount of debt to EBITDA that's going to define our success. And then we can dial in from debt to EBITDA to how many barrels that they need to have hedged. And in this case, so what it does is it removes the percent hedged, and now you're focused on budgetary performance instead. So that's really what we're doing in the book. It may sound a little bit dry, but it really works. It works fantastically well because you're making sure that you're meeting your budgetary numbers.
So presumably some of your producers have been following this way before the book's coming out, and so they are probably in relatively decent shape going through this crisis because they have
our clients typically and generally speaking, by the mere fact that they hire a hedge advisor, they typically are more hedged for starters. Right. So what they'll do is they'll have more aggressive hedge programs, and yes, they are in much better shape than the other clients that are out there. Or I say the other, producers that are out there that are not clients, generally speaking, because those clients are less hedged and they have more difficulty.
Hmm.
Well, risk revenue does a great job. I do know, I've seen a lot of or some of their presentations, and Andy, you guys just do a terrific job. I know this is probably the most challenging time of your entire career, but I'm sure that you're giving, just listening to the advice you've given our listeners, I'm sure you're giving your clients unbelievable advice. I will put another plug in for risk revenue because you and I, Andy, I know you may not remember this, but earlier the year or late last year, you were saying, if the market ever gets to 55, you should really just hedge as much as you possibly can, and that was obviously that was an awesome call.
Well, thank you very much, Andy. On the other side of those risk-driven hedges that we talk about a lot, we really focus a lot of the book on risk-driven hedges. The other side of it is the market-driven hedges, and market-driven hedges are more opportunistic in terms of more of a subjective call. You're trying to weigh a lot of factors in terms of the fact that you can go on offense and say, hey, look, we're getting a good price here. Maybe we got a little bit of a geopolitical event. Fairly consistently, we've been advocating for a long while now hedges over $53. And then all of a sudden, late last year when hedges were up at $58, and let's say, Cal 20, we were just saying just hedge at current prices. In other words, it wasn't even like we had like a minimum target there because 53 was in the bag. Just hedge it at current prices. We like the price. And I think, 2020 hindsight is very, very clear now that, in December when the Saudis did their IPO that was pretty much about it. But we didn't know that at the time. I mean, everyone was kind of talking about it, and then the market kept on going higher in the next month. But at the same time, we stuck to our guns, and we kept on, advising our clients to use that good price to hedge. And the ones that did are in very, very good shape. A lot of our clients, many of our clients, used that opportunity to put on really, really good hedges for Cal 20. And now some of them are looking at Cal 21.
And we also know, Jim and Andy, our clients don't always listen to all our advice as much as we may beseech them, to do something. But it's great that you got a lot of your you got your clients to hedge aggressively.
Well, I'll give it
when the market. There were a couple of spikes. I mean, in the fourth quarter when the Saudi facilities were bombed by the Iranians, and the market spiked. And when Soleimani was killed, was that early? Was that in January?
Soleimani was January.
Yeah, boy, it seems like it was about 5 years ago.
Andy Lebow, this question's for you. Are you happy you're not on a desk right now?
Yeah, I am happy I'm not on a desk right now, doing more advisory work.
Very good. What anything else, Andy Furman, you want to add to this discussion? Andy Lebow, what else? What are we missing here?
Well, just to sum up the fact that process risk management is just an organized way to enable clients to take control of their risk and do it consistently and make sure that they are able to reach their budgetary objectives. It's a really good process that keep you out of trouble. And you know what the next battle is, gentlemen? The next battle is going to be for the consumer.
Right.
When they come back.
When they come back.
Very good.
They will come back. Okay,
Andy,
guys.
Very good, guys. Should we wrap it up? We're good?
Yeah, let's wrap it up. Andy, we want to thank you for joining us. And again, you can find more about you and the company on riskrevenue.com. And when is the book coming out, Andy?
Probably July.
Okay, and then you'll be able to find it on Amazon and Barnes and Noble.
It'll be on Amazon. Yeah, Forbes actually was the one who came to us about writing the book, so it's a Forbes book, and it'll be on Amazon.
Beautiful. I love the title.
Yeah, me too.
Yeah,
and you can find us on commodityresearchgroup.com. My email is alebow@commodityresearchgroup.com, and we should, in about a couple of weeks, Jim and I will be back to be doing our usual monthly report, and I'm sure 2 weeks from now we'll have plenty to talk about, Jim.
Of course. Okay, thanks, Andy.
Thank you very much for having us.
Okay, thank you.